One of the popular strategies recommended for retirees is the three-bucket approach. This retirement approach can withstand short-term dips in the stock market because it prevents retirees from selling low to cover day-to-day expenses. So what are the three different buckets? Let's dig into it. The first bucket is called the cash bucket. Ideally, this bucket should be able to cover 1 to 2 years worth of expenses. This bucket does not expect to beat inflation, but it provides the investor with the much needed liquidity to cover monthly expenses. This bucket also prevents the investor from pulling out money from other buckets during recessions and market downturns. This bucket also includes an emergency fund and other financial goals with less than 2 years time horizon, such as travel. In the Philippines, this bucket comprises cash on hand, cash deposited in traditional and digital banks, money market funds, and short-term treasury bonds. The second bucket is called the income bucket. This bucket is for medium-term holdings with a time horizon between 3 and 6 years. The primary purpose of this bucket is to generate regular income for the investors regardless of the market situation. This bucket should match or slightly beat inflation. In the Philippines, this bucket includes modified pag-ibig 2, blue-chip dividend stocks, real estate investment trusts, intermediate bonds, and preferred stocks. The third bucket is called the growth bucket. This bucket is for long-term holdings with a time horizon of 7 years and beyond. The primary purpose of this bucket is not just to beat inflation, but also to grow the portfolio. This bucket includes passively managed index funds, actively managed equity funds, blue chip, non-dividend paying stocks, and crypto assets. These investments are risky in the short term but tend to generate higher returns in the long term. The longer the time horizon, the less risky these investments become. Now, how do I know how much I allocate in each of the buckets? I use the formula from John Bogle, the father of index fund investing and the founder of Vanguard. Before his death, he advocated using 120 minus a person's age to determine the equity allocations. Applying this formula to my personal situation, this would be 120 less my age of 34, and I will come up with 86. The result of the formula means 86% of my portfolio should be allocated to my equity securities. But instead of allocating it to equity only, I want to personalize it by allocating it instead to my growth bucket, which comprises both equity securities and crypto asset. On the other hand, the other 14% will be allocated to the cash and income bucket. To determine the allocation between cash and income, I would first compute the money that I would need for 2 years worth of expenses. Let's say my cash bucket needs 5% allocation to cover my 2 years expenses. In that case, my income bucket will then comprise 9%. In summary, that would be 86% in the growth bucket, 9% in the income bucket, and 5% in the cash bucket. Please remember that this is just my personal investing choice. Each person has a different risk appetite. If you think 120 is too aggressive, then you can lower it down to 110 or even 100. One of the reasons why I like this approach is that it gives me peace of mind. I can sleep well knowing that my portfolio is not 100% invested in risky and volatile investment securities. I am okay with the fact that even if there is short-term volatility, my portfolio will not crash much because my investments are diversified into different securities with different risk profiles. Now, suppose there is a recession and market crash, and you need to add additional cash into your bucket 1. Instead of refilling bucket 1 from bucket 3, you can take the money required from bucket 2 instead and leave the bucket 3 to recover. On the other hand, suppose we are in a bull market and your bucket 3 has performed really well. In that case, you can allocate some of the cash from bucket 3 to bucket 1 first, then to bucket 2. If bucket 1 is still full, bucket 3 can move some of its cash to bucket 2 to maintain the percentage allocation. You can always go back to your target bucket allocation. Also, rebalancing doesn't have to be done on a monthly or quarterly basis. A yearly rebalancing is enough to assess the distribution and performance of each bucket. Always remember that personal finance is more personal than it is finance. What works for others may not work for you and vice versa. I hope you learned something today. If you like this video, please give it a thumbs up, share it with your friends, and don't forget to subscribe. See you later. Salute.